Let me ask you something. What if the first thing you learned about gold was actually wrong? Not just slightly off, not just missing a detour, but actually fundamentally structurally wrong. See, here's the thing. Right now, as I'm making this video, the Middle East is a bit of a mess. Obviously, you know exactly what's going on. And if you open the gold chart, if you open gold on TradingView, you would expect that to be in a safe haven to be higher, like exponentially higher, given the geopolitical tensions. But if you actually look at what's going on, you'll be pretty disappointed. See, one of the first things you actually learn in trading is that gold is a safe haven. It goes up in terms of uncertainty, recession, geopolitical tensions, and it goes down in the opposite context. That is what you learn. 95% of traders, that's what they know about gold. But now, just looking at this chart, since the whole Iran thing started, well, you should have figured out that the safe haven definition of gold is fundamentally wrong. Gold is not a safe haven. So let's say you're new to trading, someone, a mentor, a YouTube video, a book, it sits you down and it teaches you 3 sentences. Gold is a safe haven, gold is an inflation hedge, gold moves opposite to the dollar. Perfect. These are the basic definitions that pretty much, if you look for gold fundamental analysis on Google, whatever, every article is going to tell you these 3 things. Okay, so you open up a chart and a geopolitical headline drops, an escalation in this case, obviously Iran, escalating tensions. And well, you would immediately think that gold, being a safe haven, should go long, should go up, but it's not. Now, don't get me wrong, sometimes this works, and I'll explain you when and how that works. But essentially, leading up to a geopolitical event, the lead up tensions into it are bullish. But I'm going to explain this later into the video. Right now, I want you to understand the dangerous part here, because I really want you to hear this. The problem is not that, these 3 definitions are wrong. They're not exactly wrong. They're just incomplete. And an incomplete framework is actually even more dangerous, because it gives you confidence without actually giving you context. It tries to give you knowledge without actually giving you understanding of things. So you feel that, gold is a safe haven, so you think you know how gold should move because of that. You think you know what should happen. But if you're watching it like this, you're just reading even less than half of the page. Okay, see, geopolitics can be a short-term boost. They can be a short-term accelerant, but the overall trend is always dictated by something else. That something else is interest rates expectations, okay, and then eventually actual interest rates. And you can see that in this specific chart. In candlesticks, you can still see obviously gold, and the overlaid line is the aggregate interest rate expectations from pretty much all major central banks. The lower this line goes, the more rate hikes get priced in, okay? And the higher this line goes, the opposite happens essentially. So rate hikes get priced out, and at some point, above obviously the 0, rate cuts start to get priced in. Now, I'll show you later into the video how to actually use and get this indicator for free on TradingView. But stick with me here for now. You can clearly see that if interest rate expectations move in a hawkish direction, okay, pricing in more rate hikes, while gold falls. Okay, these 2 are correlated. So if the interest rates expectations move in a dovish direction, so pricing either out the rate hikes that they priced in before or potentially pricing rate cuts, then gold rises. That's the simple definition of how gold moves. Now let me give you the more in-depth definition, the one that actually sticks and the one that gives you logic and understanding of really what's actually going on. See, gold is a non-yielding macro asset. That sounds a little bit too, textbook stuff, but stick with me here because this is one of the phrases that explains pretty much everything. Non-yielding essentially means that gold pays you nothing. Okay, what do I mean here? Of course, gold pays. It pays if it goes up, yes, but yield, the word yield, doesn't mean gain. It means interest, almost passive interest. For instance, bonds pay a certain amount of interest. They can pay 3%, they can pay 4%, 5%, whatever interest rates are for that maturity. And even if they don't move, they'll still pay you interest. That's the treasury market. So what yield does gold pay if it doesn't move? Well, nothing. Gold pays nothing. If it doesn't move, it pays nothing. If it actually goes down and you own gold, you're actually in a loss. And that's where everything comes together here. Because now think like an asset manager that has to decide whether to allocate, 30% of the portfolio to bonds or to gold. Well, if you have to do that, well, the question becomes, what am I missing by holding gold instead of holding bonds, dollar, cash, or another currency, and so on and so forth? This is called the opportunity cost. And this is where it gets really interesting and you start to see the logic. If treasuries, in this case bonds, obviously treasuries are bonds, if bonds offer you an attractive yield, let's say 5%, then gold suddenly has to compete against that 5%. That is literally paying you to wait. You can sit in treasuries, sit in bonds, and get paid 5% passively. Gold doesn't have that. Gold doesn't pay you interest. So when the other alternative to gold, treasuries or obviously cash, because if treasury pay you 5%, then even the dollar, becomes a carry trade, so you can hold dollars and actually get paid at 5% as well. So you have to understand here the attractiveness of the two sides. If one side is paying 5% to just do nothing, and gold is paying obviously 0% because it doesn't have a yield, gold is a non-yielding macro asset, then funds, asset managers, macro managers, fund managers, everyone is more incentivized to hold obviously bonds instead of gold. So in this context, if interest rates are high, hence if the treasuries pay you 5%, 4%, whatever, or expected even worse to go higher, then gold struggles to compete in this environment. Understand so far? Okay, now let's flip it around, obviously. If rates are falling, so bonds maybe pay 2%, and inflation, let's say inflation is 3%, so actually you're losing purchasing power, you're losing 1% a year by holding treasuries, then suddenly gold looks like a much better alternative. It doesn't pay you interest in this case, obviously, but it pays you the return, it pays you obviously the gain advantage that you can gain if obviously gold rises, but most of all it protects as well from the loss of purchasing power. So let's make this practical. Let's make this mechanical. When the market believes the Federal Reserve or major central banks across the globe are going to stay restrictive, meaning keeping interest rates high, maybe even hike interest rates, essentially they're looking to keep things as restrictive as possible, which means keeping interest rates high or high. In this scenario, this acts as a counterbalance to gold, because gold right here feels the pressure of, its competitors essentially, okay? Its competitors, let's say, are yielding 5%, gold again yields 0%. In that case, gold feels the pressure because funds move out of gold and into bonds or the dollar. Now, when the market believes the opposite, so the Fed is going to cut interest rates, accommodative means keeping interest rates low, stimulating the economy, maybe even cut interest rates. Well, in that case, bonds pay less. Maybe comparatively speaking to inflation, there's actually the loss of purchasing power because maybe bonds pay 2% and inflation is at 2.2%. So there's actually a loss in purchasing power. In that case, gold becomes a perfect alternative to that because it protects from the purchasing power loss and actually it incentivizes the gain. So a fund manager are actually looking to position themselves in an asset to put funds to work in an asset that should actually go up in this environment. Now, if you want to understand a bit more about this nuance, I've made a full video on that, which you can actually find right now linked at the top right. But for this particular video, let's keep it simple. The context you have to understand is that if interest rates move in a hawkish direction, so if interest rates go up or are being kept high for long, then gold feels the pressure of that. Okay, gold tends to fall. On the opposite side, if interest rates are being cut, are being kept very low, then gold actually tends to rise in that. So, all this said, let's bring this back to the context right now. See, the Iran situation is creating a context in which energy prices are rising. Oil is rising towards 100. It's been towards 100 for a couple of months now. It's actually fallen a little bit, but it's been around 100. It still is elevated. Now, that is forcing central banks across the world to hike interest rates. The Federal Reserve is expecting, now it's being priced to potentially hike once this year. The European Central Bank is expected to hike twice this year. Bank of England, Bank of Japan is expected to hike. The RBA has been hiking already 3 times this year and is expected to hike once more. So this is exactly why gold can fall and does fall even during geopolitical tensions. Not because gold is not working as a safe haven anymore. Gold, it kind of is a safe haven, but if you stop yourself at that definition, you're gonna miss everything else and you're gonna get caught in the wrong side of the market, because the geopolitical event is not just a matter of the geopolitical event itself. Now, right now, what's happening is that the geopolitical event is feeding interest rate expectations to move in a hawkish direction. So the safe haven nature of gold makes it attractive, yes, but higher yields, higher interest rates make gold less attractive because they make the dollar more attractive, they make treasuries more attractive, and over the medium term, interest rate dominates, okay? And this is not new. We've seen this movie before. Back in 2022, Russia invades Ukraine, geopolitics explode, and this is the important part, before the event, gold is the safe haven. Now, there's no question about that. Before the event, either you can see actually what happened this year as well. This is where the actually military campaign against Iran started. Before the event, gold tends to get those safe haven flows. But then after, we get the interest rate side of it. And the same thing happened in 2022. So gold before the actual event, because the markets is smart, intelligence is smart, it was being seen quite in advance what was going to happen. So before the event, actually gold saw some inflows, some safe haven inflows. In this case, it actually saw it after it as well. But then what happens? After the initial boost, after the initial geopolitical safe haven premium, then interest rates dominate, okay? You can see in the orange line right here, you can see the real yield, which started to push higher as the Federal Reserve started to hike rates aggressively. And it wasn't just the Federal Reserve, this was every central bank across the globe were hiking rates aggressively. This pushed yields and interest rates across the world higher, and that pushed gold lower. That's what happened in 2022. And this is what's happening right now again. See, geopolitics can create a spike, but interest rates expectations decide whether that spike becomes a trend or it actually becomes the opposite trend. In this case, it fades obviously lower. See, the key point here is understanding how the geopolitical event feeds into interest rate expectation. And you're going to see in a minute how you're going to be able to do that for free on TradingView. I'm going to show you in a second. But to put it into 2 sentences, if the geopolitical event leads to falling real yields, weaker growth, and easier policy expectations, so central banks to cut interest rates because they have to support the economy, then gold can trend higher. But most of the time, it happened in 2022 and it's happening right now, the geopolitical context tends to lead to higher inflation and central banks to be hawkish to hike interest rates eventually. In that case, gold, it completely disappears. The safe haven appeal completely disappears in gold. And it's all about interest rates in that case. So if I want to oversimplify this as much as I can, geopolitical tensions do not automatically means gold up. The real question to ask is what is happening to interest rates expectations, okay? Everything else is just noise until you actually answer what is happening to rate expectations. So now, naturally, obviously, you may ask, well, how can I always know what's being priced into the market, what's happening with interest rates expectations? So whether expectations are moving in a hawkish direction, so higher rates, or dovish direction, so lower rates. Now, I've created a TradingView indicator for that, completely free. You can add it to your charts and save that as your favorite indicator. So you can access this quickly anytime you want. And it's completely free. Just go on TradingView, search for global rates expectations and add it to your chart. Now, actually, I've published this a couple of hours ago, so I'm not sure how long it takes for TradingView to actually push it into the public indicators list. I think by the time you watch this video, you should be able to search the indicator in the public indicators list, But if it's not there, then in the description below of this video, you'll find the link to the indicators page, this one, which you can use then to add to your chart, add to your favorites, and also actually give it a little boost, push the indicator to more traders, let them know that interest rate expectations matter, okay? Now, when you add this indicator to your chart, the first thing you're gonna see is this model right here. It's simply rate expectations for each central banks. You're gonna see the Fed, you're gonna see the European Central Bank, the Bank of England, the Bank of Canada, the Bank of Japan, and there is the Bank of Australia, each in their individual line. Now, for gold, in this case, we're talking about gold. If you want the aggregate mode that I've shown you earlier, where you can see everything under just one line, just go to the indicator settings, click on this dashboard view, and click on global rates. This is going to switch the indicators into this mode here, which is just one aggregate line of every central bank, but into one line, into the composite of every central bank, actually also weighted by importance, okay? So the Federal Reserve is weighted more, the European Central Bank is weighted a little bit less, and so on and so forth. Now, the most important thing to remember here is that the lower the line goes, so the indicators line the lower it goes, the more it's being priced into a hawkish direction. So in this example, if the market is going to price more rate hikes, then this line will move lower, okay? And higher, it actually means less rate hikes in this case. And at some point, obviously, when it goes above the zero, rate cuts start to get priced in. So the main takeaway you should take from this indicator and this video as a whole is that, again, gold can be a safe haven, but if you stop at that definition, that gold is a safe haven, then you're not going to be able to trade gold properly when these things happen. So, okay, the key question to understand whether you should be bullish or bearish on gold is that, is the market reducing the opportunity cost of holding gold or increasing it? So, are interest rates expectations moving in a hawkish direction or moving in a dovish direction? Okay, they're being priced more rate hikes, more cuts, less hikes, whatever it is for the context in question. Okay, in this case right here, right now, you have to pay attention on whether, obviously, more rate hikes get priced in or lesser rate hikes get priced in. And the key variable there, then besides this, is the geopolitical context, okay? If there is a settlement, a deal negotiated that opens up the Strait of Hormuz, then in that case, central banks are going to be able to hike less, potentially some, not even a hike at all. And that's going to push this line higher. Remember, if it happens, okay, if Hormuz gets opened, then this is going to happen. But if it doesn't, if the geopolitical tensions stay hot, Hormuz stays closed, well, in this case, the market will be forced to price more rate hikes from central banks because they will have to hike interest rates in order to fight inflation, the energy-driven inflation. And in that case, the indicators line is going to move lower and gold actually will move lower with it. So, all this said, next time someone in a trading group, a comment section, or whatever says to you, gold has to go up, it's a safe haven, geopolitical context is escalating, well, send them this video, okay? Let them see that interest rates expectations is what actually matters for gold, more than geopolitics. 80% of the time, there's a context in which, before a geopolitical escalation, before the actual sparking on the event, geopolitics then matter. But all this said, in the meantime, if you find this useful, let me know with a like down below. That's the best way to push this video to more traders.